we've identified 3 top-performing superstar ETFs with strong performance over the last 3 to 5 years and 5 years plus, with amazing performance, each in different corners of the market. Each of these 3 ETFs combines solid, strong returns in recent years, exposure to key sectors in various markets, making them appealing for long-term investors. Number 1, Vanguard FTSE, Canada All Cap ETF, TSX VCN. This Vanguard ETF tracks the FTSE Canada All Cap Index, covering large, mid, and small cap Canadian stocks. Morningstar notes VCN delivers broad exposure to the Canadian equity market at a low cost, meaning it represents virtually the entire Canadian stock market. Performance: VCN has surged in the past 2 years, 22.2% in 2024 and 12.3% in 2023. Over longer horizons, it's also delivered solid returns, roughly doubling since late 2018. 5-year total gain, 108%. It broadly mirrors Canada's market, which rebounded strongly in 2021 and 2024 and recovered after a pullback in 2022. The cost to buy, the NAV or net asset value, is currently $53.40 as of mid-May 2025. The VCN is highly liquid, trading hundreds of thousands of shares daily. The expense ratio MER or MER is 0.05%, currently the lowest in Canadian equity ETFs. MoneySense highlights that VCN, along with iShares XIC, have vanishing small fees, which help boost net return for investors. Dividends. Currently, dividends are paid out for this ETF quarterly with an average yield of 2.8%, reflecting relatively high dividends for Canadian stocks. About 65% of VCN's portfolio is composed of dividend-paying sectors like financials and utilities. Other factors. Total assets are 9.3 billion Canadian, so it's very large and liquid. Total holdings include Canada's biggest banks and companies: RBC, Shopify, TD Bank, Enbridge, Brookfield, and so forth. So it spans finance, tech, energy, etc. In short, VCN is a broadly diversified core Canadian market ETF. Morningstar says it covers about 98% of investable Canadian market caps. Its low fee and diversification means it's a hard-to-beat ETF for its risk-adjusted basis. Number 2, BMO Nasdaq 100 Equity Hedge to CAD ETF, TSX ZQQ. ZQQ aims to mirror the US Nasdaq 100 index hedged to the Canadian dollar. This gives exposure to the top 100 non-financial US companies, mostly tech and growth names, without currency fluctuations. Its performance reflects the tech rally over the past decade. Performance. ZQQ has delivered very high returns. Its 1-year total return is about 14% trailing. More dramatically, it compounded to roughly 73% over 3 years and 114% over 5 years. For example, ZQQ returned 45.3% in 2022 and 52.5% in 2023, years when big tech stocks soared. Over 10 years, its total return is even higher, outpacing most broad indexes, thanks to its heavy tech weighting. Cost to buy? The NAV is currently about $148.50 as of mid-May 2025. It trades tens of thousands of shares daily, so liquidity is very good. The expense ratio, MER, is currently 0.39%. This includes a 0.35% management fee with a small administration cost. That's moderate for a sector ETF. Dividends. This pays out a small dividend of 0.36%, since most US tech companies choose to reinvest their profits rather than to pay out higher dividends. Other factors. Assets under management are about $1.93 billion. ZQQ's top holdings are the Nasdaq giants Apple, Microsoft, Nvidia, Amazon, Meta, etc. So it's heavily concentrated in technology and growth stocks. This means higher volatility and risk, In bull markets, it excels. It will fall sharply in tech sell-offs. It fell about 34% in 2022, albeit it rebounded strongly right afterwards. Insight: ZQQ's strong return streak is driven by big tech names. In case you're new to my channel, I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada. I talk about personal finance, investing, and investment portfolios. If this sounds like something you'd be interested in, consider subscribing to my channel. While we didn't find any direct quote by analysts for ZQQ's, its strong performance speaks for itself. As one analyst observed, the NASDAQ 100's leading companies provide exposure to innovation, growth, and stability, all within one fund. In other words, ZQQ lets Canadian investors ride the big US tech boom, hedging for safety. Number 3, Vanguard S&P 500 Index ETF, TSX VFV. VFV tracks the S&P 500 US large cap stocks on the TSX. It offers broad US exposure with a Canadian trading ticker. This is a popular choice to diversify outside Canada. Performance: VFV has shown strong gains. It returned 35.2% in 2024 and 23.2% in 2023. Even with the 2022 pullback, negative 12.6%, its recent 3-year average is a very healthy 18% per year. Over 5 years, it's roughly doubled 170% in total. These figures are in Canadian total return terms. Cost to buy: the NAV is currently around $147.85 as of mid-May 2025. It's extremely liquid with 22.4 billion UAM, so its spreads are very tight. Expense ratio: the expense ratio is only 0.09%, with a 0.08% being the management fee. These low fees are the reason for its extreme popularity. Dividends: this dividend ETF pays out quarterly at a dividend yield of 1.1%, which is lower than Canadian funds, but reflects the norms from US payouts. VFV is the largest S&P ETF in Canada at an AUM of 20 billion. Boy, the acronyms just kill you, don't they? And is often a top performer on the TSX. Hey, do me a favor. If you feel like you're getting something out of this video, would you hit the like button? And also drop me a comment saying what you think is the best ETF. Its holdings are the S&P's top companies: Apple, Microsoft, Nvidia, Amazon, etc. In short, it provides diversified US growth exposure. ETF Database points out that investors' appetite for low-cost index exposure remains strong, especially in Canada, a trend that benefits VFV. In practice, VFV, with its low fee and massive scale, is widely used by Canadians to capture US market returns. One expert notes it carries an expense ratio of only 0.08%, making it one of the most affordable funds on the market. So in conclusion, each of these ETFs that I've presented offer a compelling mix of performance and diversification. BCN covers Canada's broad market at rock bottom fees. ZQQ lets you ride the US's tech growth, hedged to CAD, Canadian currency, and VFV gives you the S&P's gains in a low-cost package. As always, consult a financial advisor to make sure that these ETFs align with your risk tolerance and financial goals. If you're curious about how to build a rock-solid investment portfolio, you might want to check out this next video here.